And where are you seeing these unloved opportunities in China and Asia?
Well, look, we would point out that China is acting very much like a post-COVID economy. Domestic airline travel, for example, is back up to pre-COVID levels. This has been done with social restrictions. China's benefited from a large shift in Western goods consumption from services into goods. So export growth has resumed at a double-digit pace. What the really untapped opportunity is that the rest, particularly South Asia and Southeast Asia, have double-digit declines in equity prices this year. So very different from the powerful rallies that we've seen in the Chinese market and in the United States. The very tech-led, we call it COVID defensive composition of markets has allowed the United States to benefit a great deal. And it's now really down to those other parts of the world that are racked by COVID difficulties. A good part of Southeast Asia is tourist dependent, like a good part of Europe. We think that the vaccines will be a game changer. By the second half of 2021, we will see a marked broadening of economic growth. So as a starting point, the rest of Asia that is a trading partner of China will benefit from that resumption of Chinese export growth. And later on, we're going to see the resumption of services activity for markets that have posted, again, low double-digit declines this year, unlike the 30% return you've seen in China in US dollar terms this year.
Is there a risk, though, in timing a return to travel and tourism stocks? Because here in Australia, we found out the risk yesterday of assuming the worst is over. It was those stocks that got really beaten up.
Well, that's part of the issue, is timing is not a very good thing for anyone here. I think we saw in March and April of this year the fastest market movements in history. We've just had a lot of great news about vaccines in the past month and a half. There's no doubt for us that there will be setbacks along the way. What we've seen out of the United Kingdom is a scary thing for markets, and it could obviously incentivize some profit taking. We've seen a big short base in the US dollar, which is an issue for emerging markets if we have a bit of a reversal. A lot of bullishness in certain recovery plays, like copper, for example. All of these things, again, suggest that there will be give and take in markets. But in the end, this COVID shock has been tremendous. And only about 1/3 of the dispersion that we have seen across world financial markets has been unwound by the impact of the vaccine news, which again, we've very much anticipated and braced for. So it could take a while, it could take all year, it could take a few months. But there's a lot of improvement that's still to be priced in, a lot of rotation within markets over the coming year that's still to be priced in. And that doesn't assume that we go back again to exactly the way it was pre-COVID.
The give and take, will that apply to the tech stocks and the tech rally that we've seen? This GTV chart on the Bloomberg showing how those Asia-Pacific tech stocks have rallied above their MSCI Asia-Pacific index since the end of September, really superior returns for a 6th straight quarter. So will it be more of a broadening of the rally, or will there be a take from these tech stocks towards cyclicals?
Well, look, I think in the case of Asia, we probably will see a broadening of the rally. There's a great deal that's been left behind solely by COVID. I don't think that you have truly excessive valuations or fundamentals that are in any way deteriorating at the start of a new cycle in Asia Tech. That's pretty much the same case when it comes to the United States, that when we looked at severe rotations like the collapse that we had in NASDAQ stocks from 2001 through 2002, it was because of a fundamental downturn. But the performance of some large cap US technology has been so tremendous. It's been so much a beneficiary of the type of solutions tech has provided to protect us from COVID that we're simply, again, not expecting a repeat of that strong performance in the coming year. It's the catch-up plays in other, what we call COVID cyclical stocks around the world. And there are big parts of Asia, for example, that are just simply not suffering the full brunt of the COVID impact that we see in Latin America, the US, and parts of Europe.
What about, you mentioned Southeast Asia, what about markets like Japan? Because we know that they have a very heavy cyclical tilt. In fact, their composition is very similar to the Russell 2000 here in the US.
So we've added an overweight to Japan again for the first time in a long while that we've had an overweight in Japan, going back all the way to when we had the extreme Abe easing cycle where it looked quite good, but that's years ago. At this point, again, Japan seems likely to be a beneficiary of the rebound in global trade activity that is already ongoing right now. I think it's important to think about shutdowns related to the coronavirus in this near term, that some of the measures of factory activity, social distant activity, utterly collapsed earlier in the year. And as you see a rise in COVID and you see an impact on personal mobility, we don't exactly have to shut down all the factories again because of that. That's not happening. And again, the composition of consumer spending has shifted to exporters, right, to goods consumption. Again, a lot of the things, tourism, hospitality, these are the weak points. They will come back, and there's a good chance that we'll see some rotation from the goods and the exporters over the course of 2021. But for the time being, again, we think that there is further to go in the recovery from this COVID shock. If there are setbacks, we think that that will represent an opportunity, and not everything will go back completely the way it was. Let's also remember that we're going to be in a different interest rate environment, a different monetary policy backdrop, with this promise of negative real interest rates for the next couple of years from central banks, that is not going to be the same starting point for the competitive market of which a fixed income relative to equities.